Good morning. I hope this finds you well. Thank you for joining us today up here in Minnesota. It's a beautiful day. Today really marks the first webinar for our monthly series that we're starting, which is really designed we got such great feedback from the fall with our Nourish series that we wanted to bring something to you on a monthly basis. So we're going to be talking about a lot of topics related to nourishment. We're going to be doing cooking again and stress reduction. But we wanted to bring a few financial topics too as well. Things like, Medicare planning, we'll be talking to a Medicare specialist, education planning, topics that are really helpful to kind of dialogue and discuss with some experts in the field. And today we thought it'd be really fitting, because it's Earth Day, to talk more about sustainable investing. This is a really fast growing and changing space. And it's an area that we're on top of and tracking, and really want to make sure we're providing you with a lot of great education, new perspectives, ways that you can think about incorporating this for yourself. So my goal for our time together today is just to provide you with education. We're joined by a great, very educated woman in this space who I'll be introducing in just a minute. But really, I encourage you to ask a lot of questions along the way as well. This 45-50 minutes is really for you. So don't forget that chat box is there. Please use it if there's questions or follow-up questions that we can help address for you. So with that, let's go ahead and jump in. I'll bring her on in just a minute. But our guest today is Kylie Miller. Kylie serves as an associate portfolio manager at Envestnet, which is one of our partners. She's a member of their portfolio solutions team. She looks at asset allocation, manager selection, research due diligence, portfolio administration, and really looking at how investors can look at environmental and social impacts and make those interests priorities in their portfolios. Prior to that, Kylie was a senior client advisor at Sustainalytics, which you probably haven't heard of, but it's a huge analytics firm looking at environmental, sustainable, and corporate governance practices. And there she supported U.S. asset managers in incorporating a lot of these principles into their portfolio process. Before that, she worked at the United Nations supporting principles for responsible investment. She holds a master's of science in sustainable management from Columbia University. She also has a bachelor's in environmental sustainability and a double minor in business and environmental economics and law from University of Illinois. So all of that is to say she knows a lot. And we're really excited to have her joining us this morning. And really, like I said, this is going to be Q&A. So it's really, we'll jump in with some questions, but please ask questions along the way. Kylie, if you want to go ahead and, there we go, perfect. Welcome. Yes. Do you want to say a word or two before we jump in?
Yeah, sure. Just hello, everyone. Thank you so much for having me today, and happy Earth Day, everyone. It's really quite a pleasure to be here. So thanks for having me.
Great. So the big kind of first question that people always have, I think people are reading things here and there in the news. Lots of different information is coming out. What is impact investing, ESG, sustainable, responsible? What are all of those things, and how can clients think about it?
Yeah, so I think, there's a lot of different names, as you mentioned, for this type of investing, and we can talk more about that. But at Envestnet, we use the term impact investing as kind of an umbrella term, and we define it as really an investment philosophy that combines an intent to generate positive environmental and social impacts alongside a financial return. So again, impact is this kind of umbrella term to describe three different buckets and approaches, which you see on the slide here: thematic investing, ESG investing, and screened investing, or negative screening. So starting with kind of values alignment and negative screening, this is really when you want to exclude or screen out an industry or a company from your portfolio. So companies that produce, for example, alcohol or tobacco or firearms, adult entertainment, or gambling, those are kind of the so-called sin stocks that people tend to want to screen out of their portfolios depending on their values. Other areas, some investors screen out fossil fuels or nuclear energy. You can also align with a religious view like Catholic values, or a portfolio aligning with Sharia law, for example. And then the second bucket there is ESG investing. And so that's really the idea that there are three kinds of capital, I guess, and this is kind of how I like to kind of frame it. So there's three kinds of capital. There's financial capital, there's human capital, and then there's natural capital, right? And companies tend to only consider financial capital. And the reality is there's human and natural capital, and those also have an impact on financial capital. So if you're paying attention to environmental and social issues as an investor, the idea is that you're more focused on the companies that are really creating long-term value, companies that are managing that human and natural capital effectively. So ultimately that will hopefully create a stronger, more resilient portfolio. So just to give you some examples of what that means in practice, ESG investing. So things that ESG investors think about, for example, are a company's carbon emissions or climate risk exposures, right? Another example is diversity measures at a company. So companies' workforce and leadership diversity, or, whether it's gender and racial as well, or their equal pay measures, or their hiring practices. Another example is, consumer privacy and data breaches at companies, tech companies or banks. So thinking about these types of issues in the context of your investment is what ESG integration really is. It's the idea that sustainability presents risks and opportunities that we need to consider as investors. Mm-hmm. And the third area is really thematic investing, positive thematic impact, right? And this is really approaches that specifically target companies that generate positive social or environmental outcomes. So examples of that could be around climate solutions, so investing in areas like green transportation, green buildings, renewable energy, or around some community-based investments, for example, around affordable housing or financial inclusion or education. So these buckets, I think the main point here is that these approaches can be used in combination with each other, right? So there are funds out there that use all of these methods, right? And each approach kind of looks different. So it's important to pay attention to that, which we will absolutely talk more about.
Yeah. Okay. Awesome. And it's interesting. I was reading literally this morning in Investment News, there was a comment that, in 2019, if we always talk with clients, with you about fund flows, and end of 2019, there was about $7 billion that went into sustainable investing. The first 3 quarters of 2020, there was about $10 billion. And then come the last quarter of 2020, there was $20 billion going into these kinds of funds. Can you talk more about, why you think everyone is getting so interested now? I know this way of investing isn't totally new. It's been around on some level for a very long time, but I think it's gotten this reputation of, if I do this, I'm going to be giving up financial returns. So I guess kind of 2 questions there. One is, what do you think has caused the interest to grow? And 2, just the thought that you're giving up something financial if you're going in this direction.
Yeah, absolutely. And it's true. I mean, there has been exponential growth in terms of just the amount of product out there in the market, the amount of funds out there, and the assets that are flowing into those products. And I think there's a lot of different reasons for why this is happening now. I think people are interested because there's an increasing consciousness in society and a heightened focus on sustainability, and that's really translating into everyday decisions. Consumer trends like buying local or organic foods, shopping at socially conscious brands, and composting and recycling and eating less meat, that's now translating to a desire to invest with similar sustainability objectives, whatever those, are for that individual person. And I think another element of that is that technology and like the rapid spread of information, right? News and media and Twitter are catalyzing this awareness, right? There's more information out there, more data on companies and what they're doing. And I think a company's role in society is changing. We don't want companies to just make their shareholders richer anymore. We want them to serve their other stakeholders, their communities and their employees and their customers, which a lot of people believe will enhance shareholder value over the long term. And I think you can think about the environmental and social movements of today, right? Climate strikes and plastic straws and the opioid crisis and the Me-Too movement and women's marches, and recently the protests over last year to confront racial injustice. I think with all of that, there's this bigger kind of interest in aligning your investment portfolio with your worldview on these types of issues. And I think the pandemic has made this even more relevant, right? When you think about the pandemic and climate change, inequality and economic challenges, they're all kind of at play right now. And there's an increasing awareness that these issues are inextricably kind of linked and related. and they need to be addressed holistically, and sustainability needs to be a main focus in rebuilding our economy now, and people believe that. And so I think the pandemic has put certain ESG issues kind of front and center, right? If you think about employee health and safety, right? So companies providing paid sick leave and family leave and flexible hours to their employees during the pandemic, labor practices, furloughing versus laying off workers, and also climate change, a huge ESG issue. It's directly related to the pandemic, right? And related to our exposure to future pandemics. So how are companies adapting and responding to climate risks? So these are the kind of issues on investors' minds. How are companies responding to the pandemic? And I think, again, this is just making it all the more relevant right now. I also think the way of investing, this way of investing is much more accessible to the average investor now. Someone with as little as $5 to $50 to invest, can do so in this way, in a sustainable way, at a lower cost through different investment vehicles like ETFs. There's just more access to sustainable investing. Mm-hmm. And I think, to your point about performance, people are scared maybe or nervous because people have historically associated this kind of investing with being concessionary, and so giving up returns to make a difference, right? Almost like a replacement to your philanthropy. Mm-hmm. And are those options out there? Don't get me wrong, but this is not that, right? Sustainable investing, ESG, is actually viewed as a way to add value to your portfolio, right? To create a stronger portfolio of companies that are really better positioned for the long term. And this has been difficult to prove out in the past because of a lack of historical data on these sustainable funds over time. They have shorter track records because they've been launched more recently, but the evidence is emerging and it's very positive.
Mm-hmm. Yeah, I thought there was an interesting Larry Fink, who's the CEO of BlackRock, big investment company, came out the last few years and has said this is now needs to be looked at, these different risks in conjunction with fundamental analysis. Can you speak to that for a minute? Just very high level. Obviously, we don't need to get into the details, but why is looking that important? Why can incorporating environmental, sustainable governance issues into sort of analysis of companies help?
Yeah, absolutely. And Larry Fink has been he's been a thought leader kind of out there in the media. His annual letter to CEOs has been centered around climate risk and putting sustainability sort of at the forefront. And I think that's pushed a lot of the agenda. I mean, BlackRock they're the largest asset manager in the world. They own a lot of money, of our money, and they have a lot of voting power, and we'll talk about that as well. But they've kind of come out and said, like, this is what we're focused on for the long term, to create long-term value for shareholders, is climate risk and also this broader kind of idea of sustainability. And I think there are a few ways to kind of think about this in terms of how it would benefit your portfolio. I think going back to you make so many decisions in life that are a reflection of your belief systems, right? Your passions and your interests, and in your career, and the way you raise children, what you buy, where you get your food. Why wouldn't you also want to align your money in that way, especially if it meant that you didn't have to give up a financial return? You could have the same investment return or better. And I think the benefit with investing this way is, again, you're not just necessarily screening out companies that you don't agree with in your portfolio. Like ESG integration and sustainable investing is really, the positive side is just as important as kind of the negative side, right? In terms of how a company's operating and the products and services that it's going out and serving society with. And so, there are investment funds out there where the investment team is specifically asking companies, how, again, back to my earlier points, how did you treat your employees during the pandemic? How are your operations exposed to climate risk? How are you working with indigenous communities that live next to your biggest manufacturing plant? Again, these are just examples of ESG integration, right? And the idea here is that including these aspects into investment decision-making processes will make a stronger portfolio, a more resilient portfolio. These companies are going to be on the right side of history and will ultimately be more profitable long-term. And I think that is what Larry Fink and BlackRock, that's what they're kind of saying when they're putting this at the center of their investment plan kind of going forward.
Yeah. And at a high level, have you seen anything in the last year, just kind of an observation of those companies that are more aligned with these things, and maybe a difference in how they're doing, or I know we can't get into detailed performance, but just kind of high level, what trends you're seeing, especially through COVID and these changes.
Yeah, I think there's been a huge focus on diversity, and basically companies being more transparent about how they're reporting on their racial and gender metrics across their workforce, and also within their leadership and their board, and what their hiring practices are like, and what programs and policies they have in place to increase and enhance diversity within the organizations, because that does translate to a better return from the company. The company is going to be more profitable long term. That's what all the studies kind of say, is when you have greater diversity, you have less groupthink, you have more diverse perspectives, you have lower turnover. Like, there's just a lot of different kind of indicators that it does translate to an increased profitability longer term. I think that's definitely a big area. And then, as I mentioned with the pandemic, I think there was a lot of focus over the last year on how companies are treating their employees during this time, and whether, again, they did furlough versus lay off their employees during this time, whether they kept their benefits going. I mean, healthcare benefits, so important during the pandemic.
Yeah.
So just, how companies are treating their employees, and that was a big one. And I think within the proxy season now, within the governance of companies, there's a heightened focus on labor practices and like human capital management, and that does directly affect the bottom line, but it also is just, again, going back to like a company's role in society, how they're treating their other stakeholders.
Yeah, that brings up a great point just on proxies. There's things I think that often get forgotten in the mix, and I think we're all probably guilty of it. But talk a little bit about proxies and what role we can play if we own different companies, or how investment firms are approaching making a difference within companies, even if sometimes you own a company that maybe isn't perfect from an ESG standpoint, but you're trying to make some changes there.
Yeah, absolutely. So there's kind of this idea that you can vote with your money, right? And I think the question is like, but how, and what does that mean, right? So as a shareholder of the companies in your portfolio, you are a shareholder, sorry, of the companies in your portfolio, and proxy voting is really a way for you to have a say in the direction of that company. So when you buy a stock, you become a part owner of that company, and proxy voting really allows shareholders like ourselves to influence company operations and decisions. And it's the primary way that you and I can have a say in how public companies around the world are governed. So, and I'll just really high level talk about how proxy voting kind of works really, really briefly and at a high level. But publicly traded companies report to their shareholders through annual shareholder meetings and other communications, and companies send proxy statements detailing the resolutions that shareholders will be voting on during the meeting. So if you're a fund investor, fund companies vote on behalf of you and other fund investors, which is why it's so important, with BlackRock, it's important when you have the asset, and it's important to know how the asset manager is voting, right, on behalf of you for these different on these different issues. And the proxy ballot can have proposals that cover a range of ESG issues. And there's been more and more ESG issues on the proxy ballot over the last couple of years. So around areas like climate change and political lobbying and diversity and data privacy. And the 2021 proxy season is actually happening right now. And some of the key ESG topics are actually asking companies to do a racial equity audit at some banks, and also at, I think it's Amazon and Johnson & Johnson. Also another area around asking companies to disclose their climate risks, particularly fossil fuel companies and utility companies. And also asking companies to stop and or disclose on their political spending. So those are just a couple of different topics that are on the proxy ballot this season. But the key point being, you can vote with your money, and you should, and paying attention to the proxy ballot that you receive. If you own an individual stock, that's really important. And then if you own funds, tracking how the funds in your portfolio vote kind of across ESG, these different ESG issues.
No, that's really helpful. And I think, the big thing here is, for you, our clients who are doing this for today, obviously, is just helping you understand what's out there, and really feeling if there are issues that are really important to you, or things that you really feel passionate about, letting us work together to develop something that can feel more in alignment. I think in the past, maybe there's been a little more of a disconnect because it hasn't been as possible. It hasn't been as easy to align these things together because, like you said, technology wasn't there, things weren't in place. And the reality is it's just changed so fast, even in the last 5 years. I mean, what are some of, you've been in this space now for a while, what are, the 3 biggest changes that you've seen, throughout that time?
Wow, the 3 biggest changes. It's been exponential, the shift, I guess, over the last really 2 years. And I guess maybe to like back up and just talk about like how long this has all been around and how it's evolved over time. I'll go way back, and I'll say that it really started out actually, and I don't know if many people know this, but it's kind of interesting. Started out in like the 1700s with the Quakers and Methodists and Muslims, again, as early as the 1700s, that wanted to kind of screen out controversial business areas to really align with their religious views.
Mm-hmm.
So it's been around for a really long time. And then in the 1970s, so fast forward, a couple hundred years, SRI really played a role in, and I'm sure a lot of you have heard about this, really ending the apartheid government in South Africa. And that's really when the industry started gaining more steam. But again, it was still, SRI is really screening out companies still. So we were still kind of in that, a lot of it was still around that approach. And in 1971, Pax World Funds launched the first sustainable mutual fund. Mm-hmm. And then fast forward to the last few years, the industry has evolved so much. I mean, it's evolved far beyond simply, again, screening out companies from your portfolio. The approaches have gotten a lot more sophisticated. There's been so much advancement in ESG data and information and disclosure and transparency from companies. Mm-hmm. And, the way this information is used in asset managers' investment decisions, it's just gotten a lot more sophisticated. There's a lot more information to take in now and consider within their processes. And investors, asset managers are so much more aware of environmental and social risks and opportunities. And now there are hundreds of sustainable funds in the market. There's been, again, exponential growth in asset flows into these funds. There are now options across really asset classes. So, small cap, large cap, international. There's investment vehicles as well. So you can really build a portfolio that's kind of holistically aligned with sustainability or with ESG, through the lens that you see it, right? And I think, part of that growth has also been because retail investors, you and I, can now, again, access ESG and impact investments through things like exchange traded funds, ETFs, with less money to invest at lower costs. And, this trend towards more sustainable options and more access, I think, will only continue to grow and get better.
Yeah, I mean, I was reading in Investment News again, kind of just that as we do surveys of different households, it shows that over 56% of households, and that's actually the lowest number I've read. I see it oftentimes up towards 70%, 75% are interested in some level of this. So just like anything, obviously a lot of due diligence needs to be done because just because it's SRI doesn't mean from a fundamental analysis it's something that is necessarily going to make sense. But what are different, different ways that people can, what different kinds of investments are out there? Maybe just to kind of review some simple, there's ETFs, there's different stock accounts, but talk a little bit about kind of ways to, like if you do have a current stock portfolio, like some of our clients have in place, what are some things that they can incorporate now? And then maybe if they're wanting to be even more focused, what are some things they should make sure to keep in mind?
Yeah, absolutely. And yeah, just to restate kind of what I said a minute ago, there are ESG and sustainability options kind of across asset classes. So globally, within equity, within fixed income, getting into also alternatives, but really, I mean, the majority is still in equity, I would say, also in the large cap space, but it's expanding. And I think, again, as investors get more sophisticated with these different ESG and sustainability approaches, they will expand into different asset classes, and there will be even more options that for you to kind of consider and think about. So there's across asset classes, increasing amount of options, and then from an investment vehicle standpoint, exchange traded funds, ETFs, which are passively managed vehicles, and then mutual funds and also separate accounts. Like there are options kind of, again, across the board. And I think if you're looking at different options, I mean, Fidelity and Schwab have actually lists of sustainable, socially conscious funds that you can kind of take a look at if you use those platforms. Morningstar also has actually a free tool that's an ESG fund screener. So you can actually go in and look up a mutual fund or an ETF by its ticker and actually take a look and see how it scores on ESG metrics. So they actually use analytics information to show kind of the ESG risk of the fund and also any areas of product involvement that it might be involved in as a fund. So for product involvement, meaning things like alcohol, tobacco, or firearms. So you can actually see your fund's exposure to those areas as well as ESG risk and a couple other different ESG metrics that you might be interested in. So there's kind of a free ESG fund screener that Morningstar offers. A firm called MSCI also has a similar kind of fund screener online that you can access. And then there's also an organization called As You Sow, which is a great organization. They have a free online tool that will show you if a mutual fund or ETF owns fossil fuels or guns or other areas that might be of interest. They also have a gender lens, and I think they have a new racial justice scorecard. Yeah, so
great. And for you, I mean, obviously we're doing a lot of we do a lot of this legwork for you. So I think the big takeaway is really we're starting to now have more dialogues around just kind of what values are important to you. What are those things? Is there an environmental importance? Is there a social justice importance? And then we can help you really think through how to incorporate that or pivot what things look like now to just kind of align even more deeply. So you don't necessarily need to remember those websites, but if you just do want to go read and research about it, there's some great resources that we'll share as well. Because this is just a space that's changing so much. So we want to help you feel really good about what you're doing and the education you have and how we can align with you to really, move in that direction if that's something that's important to you. So we've kind of addressed this, but who are sustainable investors? What are endowments doing this? Are individual? Who all is doing this?
Yeah, I mean, I think everyone is now doing this. I think the answer to who is it's us, it's you, it's me, it's folks here. I mean, there's obviously, of course, endowments and foundations are interested because they want to align their missions with their portfolios, which makes a lot of sense. But I think, I mean, really across the board, I think it used to be much more focused on asset owners, right? So pension funds and foundations and endowments. I think that's really where sustainable investing used to be. And now, again, because of the ability for us as retail investors to access these different strategies and different vehicles at lower minimums and lower costs, it's been democratized in a way that has been really great. I mean, on our platform at InvestNet, we have I think over 1.5 million investor accounts that have an ESG, they've invested in an ESG or impact fund. And that's really, we've done some analysis, that's really across demographics, across geographic locations, and the amount of money that they've invested, it just kind of runs the gamut. So it's been really encouraging to see all the growth.
Yeah, and I was listening to kind of on the pension talk, an interview with someone at BlackRock and someone who runs pension funds in California for the teachers there. And he really was saying that, they're getting into this because, they think it's better for, environmentally and social justice wise, but also just because they think it's better analysis. It's controlling for more risks, certainly being in California. They're seeing firsthand fires and destruction that's happening. So it's incorporating all of those things. And I think it's all happening so fast that, this is why we wanted to bring this conversation to you, because it's hard to keep up with, and it's something that we're tracking and we want to share with you so that if there is an interest and there is an alignment, that we can talk about it and you can reach out to us and we can have a good dialogue around it. So I think that's great. So for example, if you care, let's say on the environmental climate change front, how can you reflect that in your portfolio? Are there any measures yet that people can actually receive for certain things that they're invested in?
Yeah, it's a totally fair question. I think the key thing to highlight here is that, deciding to reflect your interest in protecting the environment within your investment portfolio doesn't just mean that you choose kind of one satellite fund that's focused on something like clean energy, that's a really small percent of your asset allocation. You can really build your portfolio, your whole portfolio, again, across asset classes, to be environmentally conscious, if that's what you want. And you can get broad market exposure and market rate or better returns while doing that. And I think that's a key point to understand, is that that is possible. And there are tons of investment options out there that pursue a climate objective in different ways. And it's good to be kind of aware of some of the differences in the types of investments you can make, right? So there's like low carbon funds, for example. That's really portfolios that underweight companies that have high carbon emissions or carbon intensity. Then you have fossil fuel-free funds, which totally exclude fossil fuel companies from the portfolio. Then you have, clean tech and clean energy funds, which might choose investments that are actually focused on clean energy related areas, solar and wind companies, companies that have energy efficiency technologies or electric vehicles, climate solutions, really. Then there's also green bond funds, and those are filled with bonds that are specifically earmarked to raise money for climate and environmental projects. So, you issue a green bond to finance an offshore wind turbine, for example.
Yeah.
And there's also just ESG funds that you might see out there that actually prioritize the environment in the investment process. So you can get exposure to being environmentally conscious within your investments in a lot of different ways. There's a lot of different types of investment products out there that can be explored for like the climate conscious investor. More broadly, the risks of climate change, right? Extreme weather and sea level rise and water scarcity and the impact on agriculture, all these things, these risks, they have massive implications for companies, right? And for their operations and their supply chains and in the products they create and in the resources that they use. So by investing in companies that are managing these risks well and are aware of them, you're really mitigating risks in your portfolio. And companies that are more prepared for the impacts of climate change will be the companies that create more long-term value for you. So it will be good for your portfolio.
Yeah, that's great. So that's a lot. So it's not to overwhelm you. I think the big takeaway is think about what's really important to you. Think about those important values, what that looks like, and we can certainly have dialogue about that. And then let us know, because that really lets us help you create some alignment there. And it really runs the spectrum. It can be military weapons, nothing invested in that, firearms. It can be abortion. It can be tobacco. It can be there's like 17 at a minimum different ways that we can approach and look at this. But I think it really starts with just a kind of a reflection of those things that you really think are important and what you want that to look like. And the new research that's coming out that's showing, hey, this is no longer an and or. It's not just I'm doing this because I want to help these areas. This is actually going to be good for my portfolio as well. And I'm not going to be necessarily giving up those returns. Of course, you have to go into the details of the specific investment and whatnot, but I think that's a great overview. So that's helpful. If people wanted to, I was just kind of looking at, kind of going through again, like what are ways that clients can get started? How can they think about this? Is there anything else that you would add to what we've been talking about?
I don't think so. I mean, I threw a lot out there in terms of the different types of environmentally focused investments out there, whether it be these, low carbon funds and fossil fuel funds and clean tech funds and green bond funds. I know it's a lot. I think it's just important to know that there's going to be a lot of different ways that investment managers label their funds, right? And you'll see low carbon, you'll see fossil fuel free, you'll see clean tech, and it's just good to know what those things mean. And you can obviously work with your advisor, or you can go onto some of these tools, online and see kind of what that really means. You can read about the and read their prospectus and see what their objectives are. If you want to dig into that, the information's there. But I think the key point is, like, there's a lot of labeling and there's a lot of the hot button sort of naming of these different types of investments. And it's really important to understand the approach that the manager is taking. And if that aligns with what you care about. Do you want to screen out fossil fuels? Do you want to just be lower carbon, right? And do you want to, or what issues do you care about? And does the manager actually incorporate those issues into their process? And look at the underlying holdings if you really do care, and see if they, again, are in alignment with your perspective on sustainability.
Mm-hmm. And remember, if you do have any questions as we keep going, you can type those into the chat. But one question that someone asked is, do sustainable companies look at traditional fundamental characteristics, traditional things that have always been looked at when you look at what makes a strong investment?
Yeah, so do you mean investors or companies?
So I mean like investment managers or ETF, different things like that. Is there a difference in construction when you incorporate these characteristics?
Yeah, so the answer is no. So basically, the way that a lot of investment managers think about it is this is additional information, like ESG information, sustainability information, is just additional information to include and incorporate in their investment process. Mm-hmm. It's more so having a better lens and perspective on different risks, right? That maybe weren't being considered before, weren't being priced into valuation models, things like that. So like around climate risk, for example, having data and information to incorporate into how you're valuing a company. It's just an additional kind of, again, risk lens and a way to understand how companies are managing their externalities, right? Because like every company has externalities, and companies actually in a capitalistic society are taught to kind of externalize their costs, right? And to say, we're going to just try to make money at the expense of, and we're just going to try to externalize our costs to make money. And I think ESG and the different information that it provides helps better understand the externalities that a company is producing and creating, and helps an investor just better understand those risks and better understand if it's a good investment for the future.
Yeah, so it's just a lot more information. So it's sort of, you take those general principles that we look at, and then you sort of layer on these additional metrics to say, let's also look at this, let's also look at this. And oftentimes those are the more forward-looking companies, they are the ones looking ahead to the future and what they want things to look like. So I think that's a key piece, as we look at this. So I think that's great. How do I know, or how can I find, what these funds are really doing? Are there any kind of general ways that you measure change, or what's out there as far as how you can see a measurable impact of investing according to these lines?
Yeah, so I think a big one is, again, this is really if you want to decide to dig into this, right? And you're like, if you don't agree with certain holdings in a portfolio, you want to understand why they're in there, right? If ExxonMobil is in a climate solutions fund, that maybe that raises questions for you and you want to know why. So I think a big first step is kind of reading about the investment objective of the fund, like in the prospectus, the process really, and then seeing if they also publish any ESG or impact reporting. So say you look at and you see there's a low carbon mutual fund out there. Maybe they also report on their carbon footprint versus a benchmark to show the things, from a carbon emissions perspective of your investment versus the benchmark. That's a great way to just see if what their objective is actually what the outcome is of the portfolio.
And sometimes when you look in, an ETF that they say is ESG, you will see some names that all of us are pretty familiar with. And you're like, oh, that's surprising to me. I'm surprised that's in there. Can you speak to that at all?
Yes. So I think it really goes back to how it all depends on the approach to sustainable investing that you have to just better understand, right? And I think some people get angry when oil and gas companies are in a portfolio labeled sustainable because maybe they believe that fossil fuel companies are not part of the solution, to transitioning to this low carbon economy to climate change. Other investors, though, will tell you that they want to invest in oil and gas companies that are improving their sustainability practices, right? And because they believe that they're part of the, the transition, and they need to be on board in order for us to kind of create the future that we want. Maybe the investor is engaging really heavily with Exxon or with Chevron or with Shell to help them better understand their climate risks and actually invest in renewable energy. And they're pressuring them to do that. So I think that there's a lot of different ways you can think about how the climate and how, what your perspective is on how you want to affect change. And there's just a lot of approaches and ways of thinking about it, and everyone kind of has their own perspective on what sustainable means. So it's important to kind of find funds with the approach that resonates for you.
Mm-hmm. No, I think that's great. So this is a lot of information, that we've shared with you today, but really our goal with through doing this was just to provide you with some new perspectives. I didn't realize that I could do this, or I could incorporate something like this in my investments. I didn't realize how far the space has come, even in the last few years, and how many more opportunities are available. And it's something that we're definitely staying on top of, because the world is changing, what we want is changing, and there is some good research to show that looking at things through this lens can be really effective. So we encourage you to think about it, to dialogue about it, talk with us about different things that might be important to you, and we would love to help you just think about ways that you can, if there are things that are important, you can better align. And I think the great thing now is that there's so many really easy ways to do it. I think easier than ever before. 5 years ago when we were looking at this, it was how do we build a really good, well-diversified global portfolio that follows everything that we know about what makes a sound investment. And it was, well, this is going to be a little bit tricky to really get everything that we want in there. Now it's a lot easier to look at it, or to say, hey, I do really want to screen out companies that aren't aligned from a social justice perspective, or nuclear firearms, and that's really important to me. And now that's a lot easier than ever as well. So I think this has been a really helpful conversation, I think, to share with you and help provide some information. Kylie, is there anything else that you think we haven't covered that would be helpful for people to know?
I don't think so. I think we covered a lot. I know I threw a lot out there. But yeah, just to your point, I think it's, the space is growing exponentially. We're just going to continue to see more investment products out there that offer a range of different approaches to ESG investing, and hopefully then you're able to build a portfolio that aligns with exactly kind of your values, your belief systems, your personal convictions, and that allows you to reflect your worldview in your investment portfolio. And that's ultimately the goal, right? If that's something that you want. So I think there's just going to be more opportunity and more opportunity for that alignment in the future, and that's really exciting.
Yeah, no, that's great. Well, thank you everyone for joining. Kylie, thank you so much for your time today. We hope everyone has a great day, and like we said before, please reach out if there's any questions we can help you talk about. And we hope this was a good, we'll keep offering things, but just a good tip of the iceberg to start thinking about what this world looks like and how we can think about it for ourselves.
Thank you so much.
Take care. Bye-bye.
Take care.